Good afternoon. Thank you for tuning in today. My name is Paul Latta with Glacier Peak Capital. I'll be talking a little bit about the US dollar, what that means for your portfolio and for the economy. Dollar has been in the news quite a bit recently. Thought it would be worthwhile looking into a little bit more detail about what's actually driving the dollar and what that might mean for investors. I picked this slide off of Google Trends just to show sort of how topical is the U.S. dollar and the strengthening. And you can see that, and just in particular in the last year and a half here, that it's actually been in the news quite a bit with a sharp rally. So people are actually looking into this and are quite curious. In particular, in the last 18 months, we've seen a very sharp rally in the trade-weighted dollar. This picture here is over the last 10 years, and you can see with this big arrow here that we've actually had quite a steep move here. With the dollar strengthening, that does sort of bring up sort of the conventional view that I think most folks perhaps studied in their Econ 101 class about what works when the dollar gets strong, what works when the dollar gets weak. But the conventional view anyway is that for those of us here in the U.S., a strong dollar is quite good if you're, say, an importer, or if you're a consumer. It makes it easy to travel, say, to Europe with a stronger dollar. A good time to go visit Whistler. Not so good if you're perhaps Boeing and you're exporting airplanes. Makes you a little bit less competitively advantaged against Airbus. And also not so good if you're a producer, especially a producer of raw materials. If you're outside the U.S., of course, a strong dollar, not so good for consumers, makes it certainly more expensive to travel to the U.S. And of course, the flip-flop for a producer, if you're, say, Airbus, based in Europe, the weaker euro, you're suddenly more competitive against, say, a Boeing. I'm going to talk just a little bit more about a strong dollar and what that means. This is perhaps a little bit more detailed insight, although it looks simpler. But in essence, when the dollar gets strong, that is actually quite good for people on the finished goods end of the value chain, but actually quite bad for people on the raw material or early part of the value chain. In essence, when the dollar gets strong, people have a tendency to feel better, and when the dollar gets weak, people that were formerly worried about the dollar and not letting go of their oil or their bars of gold suddenly let them all go at the same time, and those raw materials, whether it be corn or wheat or oil and gas or copper, they all have a tendency to collapse at the same time as people shift from saving in assets to saving in paper. And so that's kind of the unconventional insight. We'll talk about that in a little bit more detail. Going to have quite a few slides here coming up here, but divided into basically 4 buckets here of, what does the strong dollar mean for basically investors as well as for the economy. And I've listed, these are the 4 conclusions, and we'll go into each one here. But basically, the raw materials prices, like oil prices, they will decline. I'll talk a little bit more about why that happens. Emerging markets, in particular those that may be involved in oil, but raw materials in general, which are fairly prevalent in emerging markets, those also underperform. The flip-flop, the U.S. consumer, great environment. And then like tech and biotech, in particular those sort of equity-intensive or equity-sensitive names, high beta names, actually do quite well. Those sectors have a tendency to take off. We'll talk a little bit more about each one of those in a little bit more detail. First, let's talk about the raw material prices and why it is that raw material prices, commodity prices in particular, decline when the dollar gets strong. Now, the correlation is clearly there, but it's not widely understood about the mechanism of why this is actually happening. First of all, in order to understand why raw material prices might be declining in a strengthening dollar market, you have to think about what a currency actually is, because a currency really, at the end of the day, represents the price of everything. So in the case of, when the dollar is strengthening, that means basically the price of everything is declining, or vice versa. And of course, that can start with the price going to the currency, or the currency going to the price, strengthening or weakening, but that really is what a currency is. It really represents the price of everything. Now this slide here is a little bit busy, my apologies here, but this slide is really the core of why it is the oil prices or copper prices, or pick your raw material, why it is they decline. It's I'm calling it the bullwhip effect, and the bullwhip effect conventionally is usually applied to inventory changes, and we can see this chart here where if you're the customer and you're ordering from the warehouse, who's ordering from the distribution center, who's ordering from the plant, all the way upstream in the supply chain, that there's a tendency to have just a little bit of a slush fund of extra inventory ordering each step in the value chain. So there's a tendency for really huge changes to sort of small changes to magnify into really huge changes as you go upstream in the value chain. Well, a lot of people don't understand that actually works with the pricing as well. It's not just inventory volumes, but it's also pricing. And that if you're, in the fine print down here, I talk a little bit about the paper industry in particular, and how if you go upstream from office paper to pulp to say recycled old corrugated containers, that you'll see a similar move on the price side, so that a $100 price per ton in the price of office paper will magnify to a similar $100 price increase of pulp, but off a lower price of pulp relative to paper because the conversion cost is lower. So the percentage increase might be a 10% price increase in paper turns into a 30% increase in the price of pulp, which might turn into a 150% price increase in the value of old corrugated container or the recycled fiber to make the pulp. And that bullwhip effect is really right at the root of why when the dollar strengthens, the price of kind of quote everything declines, but it bullwhips up the supply chain, so the raw materials end up with an absolute complete collapse, which is effectively what we're seeing in copper, what we're seeing in oil, what we're seeing in commodities globally right now. Very important. That's probably right at the root of what's happening. And also, because that's what's happening in the raw materials, it has a very big impact upstream into the consumer end as well. And we'll talk about that later. Might put a little bit of clarification here on this bullwhip effect, because the bullwhip effect is it's an especially important deal for the U.S. dollar, because the U.S. dollar is the world reserve currency. In other words, if you're in a foreign country, Mexico, Canada, Europe, Japan, and those currencies move, you can arbitrage the move in the underlying commodities by buying it elsewhere in the world in a non-bullwhipped region. But since the U.S. dollar is the world's reserve currency, it bullwhips the entire planet at the same time. And so the dollar becomes effectively like the anti-commodity with a magnifying effect of the bullwhip. And so the dollar is sort of unique in the sense that as the dollar strengthens, commodities just collapse. And vice versa, as the dollar weakens, when the dollar was 30-40% lower than where it is today back in 2007, oil was at $150 a barrel. That's what's happening. So this slide basically sums it up. If the U.S. dollar strengthens, the price of everything, quote, everything declines. Those price declines intensify up the supply chain with the bullwhip effect, and raw material prices, they get clobbered. I alluded to this conclusion earlier, but one way to think about the price sensitivity, or the commodity price sensitivity to the U.S. dollar, is that the world will sometimes get rich by saving in paper, or the U.S. dollars, and sometimes it gets rich by saving in assets in terms of oil. And in fact, I think it doesn't have to be oil. It could be corn or gold, or in this little picture here, we've got pork bellies, I guess, or some pork there. 1970s were clearly a decade where people got wealthy by not saving in dollars, but by putting money into hard assets. 1990s were just the opposite. Today it appears we're moving into a paper decade. This slide is perhaps a little bit busy, but I think this does illustrate at a rough level what it is we're talking about: strong dollar decades, weak dollar decades. The top chart is really just a picture of the trade-weighted dollar here in blue, and then there's a line that runs across here, which is basically the sort of the fair value of the dollar. So when the blue line is above the fair value, it's an overvalued dollar. When the blue line is below the line, it's an undervalued dollar. The valuation line, a lot of people refer to that as the Big Mac Index, or purchasing power parity, PPP. But you can see real clearly that in the 1970s, right here, the dollar was down below its fair value line, and what happened to commodities? They rallied like crazy. And then the dollar went up above its line, and what happened to commodities? They collapsed. And you can see there's a few exceptions to this rule. I might mention here, this one right here is an exception. We had a situation where the dollar was undervalued, but instead of rallying, the rally was basically stifled, and there's a handful of factors there, but basically OPEC quadrupled production during that period and basically stifled the rally. So it's probably worthwhile mentioning that there's more to the price of oil than just what the dollar might be doing. That Saudi Arabia, it actually is a big factor. But you can kind of see this continuing again, where we had another strong dollar here. This doesn't quite line up, but we had oil down around $10 a barrel that period, and then of course we had this period here where the dollar really got weak and we got up to $150 oil. So not a perfect correlation, but I think if you overlaid the oil prices chart with other commodities like copper or like gold or like wheat or corn, that you would also find similar. That corn and wheat rallied here, gold and copper and whatnot, they fell there, and so they have a tendency to rally at the same time and collapse at the same time. And you can pretty much be sure that when copper is going up at the same time as oil, that it's not OPEC causing the copper shortage. That would kind of immediately say something other than OPEC, which usually is the dollar. I thought I would include just a specific visual here to show the pendulum here that I referred to earlier, that the world does have a tendency to think in terms of getting rich by saving in assets or getting rich by saving in paper. I might mention too that that's especially true in regions of the world where they've had currency issues in the past. And so if you go to, I don't know, say Turkey, where the Turkish lira collapsed in the late 90s, it's really embedded into the thinking of folks there about how to save money when the lira or the dollar is working, and how when the lira or dollar is not working. It's very embedded in folks outside America where there's been currency issues. They effectively know how the real world works at a very broad level. Americans can be a little bit myopic and not really sense what's happening. It's not uncommon when the dollar started weakening, for example, in 2003, 4, and 5, to people to point the finger at either Saudi Arabia or troubles in Iraq or people driving too many SUVs. And while all those factors certainly do play a role, the root cause was really a currency issue, and a lot of non-Americans were on board right away. It took Americans were sort of last to the party to realize what was really happening. So let me move on to the second part of what's really going on with the dollar, and that's what's happening in the emerging markets here. And probably no surprise that when the dollar was weak back in 2005, 6, and 7, that the BRICS, Brazil, Russia, India, China, the BRICS did quite well, but the BRICS have been under a fairly healthy amount of pressure recently. So clearly there's a correlation. Let's talk a little bit more about why that is actually happening. This chart right here, a little bit busy, but it does show that what we all sort of know intuitively, that back in the weak dollar days of 2005 to 2007, that the emerging markets were getting just powerful inflows, and now emerging markets were getting pretty large outflows. Inflows into the developed markets, they're actually not super strong these days, probably not a whole lot different than even back in the 05, 06, 07 from a market share perspective, though they're actually doing quite well, mainly because emerging markets are just getting clobbered as far as outflows. Again, let's talk a little bit more about why everybody's running for the hills in emerging markets here. When you go outside the U.S., there's currency issues that are actually fairly important when it comes to not just emerging markets, but all non-U.S. markets. And there's three main factors here that are really going to dictate the currency sensitivity, and I've listed these here. One, not surprisingly, is this a consumer economy or a producer economy? Another, are we running a trade deficit, trade surplus, or perhaps maybe a balanced trade environment? And then, of course, the currency itself. Are we running a supportive currency policy, or is this perhaps a currency peg that has gotten out of control and we're looking at a possible devaluation? So those are all three factors to consider when looking at well, all markets, but emerging markets in particular. And those can actually play a role and have some explanatory power as to why emerging markets are underperforming these days in a strong dollar environment. First of all, let's think about producer countries versus producer countries, or for that matter, just consumers versus producers. As we talked about a little earlier, we do know that consumers benefit from a strong dollar. Not just consumers in the U.S., but consumers broadly speaking will benefit from a stronger dollar. Certainly, as we just talked about the commodity prices collapsing, that implies lower costs for consumers, and of course, with the effective pay raise for consumer, that does benefit in terms of consumer confidence. And between the consumer confidence expanding, you get expanding revenue for the consumer companies. At the same time, you get lower costs, the margins go up, and the stocks have a tendency to outperform. And of course, you get exactly the opposite situation on the producer side, where they're hurt basically from lower prices. At the same time, they get the destocking, and the contraction of both revenue and margins at the same time really results in some painful situations for the producer companies, and so countries that have a bias towards that can be very difficult economically speaking. I thought it would help thinking about juxtaposing two countries, one that's sort of producer-oriented and one that's consumer-oriented, just to give a flavor for how the stock markets might behave. And here I'm showing the USA versus Brazil. And all I've done here is grabbed the S&P 500 versus the Brazilian Bovespa and taken a look at the sector balance within those publicly traded stocks. And you can see here clearly that amongst these sectors that are generally regarded as strong dollar sectors, and I'm including predominantly consumer names as well as the high beta tech and biotech healthcare type names. Those are the strong dollar names, and you can see the USA, we've got a preponderance of strong dollar names. And that's been historically true for more than 2 or 3 decades here. So this is not a new phenomenon. U.S. has just been a strong dollar region. Weak dollar, very light on that. So not much in the way of oil and gas, not much in the way of materials. I'm showing here a 46% net strong dollar balance in the S&P 500 in the U.S. If you were to compare that to Brazil, and most people know just off the top of their head, Petrobras, the big Brazilian oil company, is a huge part of the Brazilian stock exchange, as well as, well, for that matter, the Brazilian economy. And so energy and materials make up a significant part, more than double what we have in the U.S. And that does elbow out a little bit of some of their consumer names. And then, of course, the healthcare side is just not anywhere near as developed, or the technology segment. And so you end up with U.S. being 46% strong dollar benefiting sectors, and Brazil only 7%. So it's not a surprise that U.S. is getting a tailwind. Brazil is basically a headwind. If you were to broaden out the case study that we just looked at, U.S. versus Brazil, and compare that net exposure, strong dollar sectors by country, you can see U.S. is way off on the left-hand side, clearly a strong dollar beneficiary. It's not the only country, but it is way off to the left. And then you can see some countries, surprising countries, perhaps Canada might be a surprise to some because it's not exactly an emerging market in Canada, but Canada does have a huge balance towards producer-oriented industries, raw materials and energy in particular. Russia, probably not a surprise, is at the far right, even further than Canada. Might be a couple of surprises out on the left. I think Switzerland's probably a slight imbalance because they have a couple of pharmaceuticals like Novartis and Roche that sort of draw the balance a little bit higher than what one might intuitively expect. And so I think that's a little bit of a false positive, but it is still a consumer bias. I might mention the same thing with Korea. In Korea's case, it's actually Samsung. And of course, Korea does have a few other consumer names, some of the auto companies, the Kia, Hyundai, and whatnot, that also bias Korea a little bit, probably more than it should. India might be a surprise to some people because it gets lumped in with the BRICS, but that actually is a very balanced economy and actually not a whole lot different than the U.S. And so Israel, to me, I'd put it in the Switzerland category because it has Teva Pharmaceuticals there that might shift the balance a little bit. And then Japan, also quite a bit more balanced than one might expect, especially for anybody who's been following Japan over the last 20, 30 years and view it as a producer economy. It's actually not quite as producer as you would intuitively expect. And so when I look at these countries on the left-hand side, I look at the top 6, I see 3 as sort of true consumer names, US, Japan, India, and then 3 sort of head fakes that are actually maybe a little bit less, but still consumer oriented, Switzerland, Korea, and Israel. On the right hand side, absolutely Russia, very producer, Canada, Australia, very much so, China, very much so, Brazil, much so. And so this to me basically tells you, as the dollar strengthens, which countries are going to see stock markets benefit and which ones are going to see a real wind in the face. So one other detail I might mention here on kind of emerging markets and why they might be underperforming. Quite a few emerging markets run either trade surpluses or trade deficits. And what's interesting about that is you would think, well, if you're running a trade surplus, you're probably in a pretty good position. Well, that's partly true, but not necessarily true, because quite a few of the Far East countries do run trade surpluses, but they run trade surpluses because they've got very export-oriented economies. And what we've seen here recently is we've seen Japan go through a proactive devaluation of the yen over the last couple of years, as well as Europe go through a proactive devaluation of the euro. And that puts the remainder of in particular the Far East, like Korea and Taiwan, in a match it or die kind of situation where if they don't devalue too, they're going to be left basically like a beached whale, sort of uncompetitive with the rest of the school of fish. And so what we're seeing then is, having a trade surplus, in theory, it's a good item, but in reality, what we've been seeing recently is sort of a round of competitive devaluations. And the competitive devaluations, what does that mean? It means it's driving the dollar even higher. So anyway, another reason to sort of be aware of the emerging markets, even those that are regarded as the good ones. There's risk. So if you think the trade surplus is a little bit risky, well, a trade deficit is not exactly a safe haven either. The problem you run into with trade deficits, obviously, is the capital flight issue. And it's not necessarily because we're seeing competitive devaluations that are impacting trade deficit countries. Trade deficit countries are usually not export competitive countries, but rather those countries that run large trade deficits. In the U.S., where here just this month we raised interest rates for the first time in 7 years. Well, rising rates in the U.S. creates a little bit of a fear of the inability to finance the trade deficit. And so what we've seen is sharp declines in countries that run trade deficits. Probably, Brazil comes to mind, Turkey, Venezuela. I think we're hearing about another Argentina devaluation just in the last week or so. Venezuela, of course, has had massive devaluations, and the country is, the bolivar is practically a non-currency at this point. So interesting dilemma for emerging markets. If you're running a trade surplus, you might be at risk of competitive devaluation. If you're running a trade deficit, there's a risk of capital flight. This slide basically summarizes what we were just talking about here, that in the emerging markets, for that matter, quite a few foreign markets, not just emerging markets, but a lot of non-U.S. markets are at risk for both the trade surplus as well as the trade deficit. And we're seeing both competitive devaluations as well as capital flight take place in many both trade surplus and trade deficit countries, and that's having the effect of strengthening the dollar on both ends of the spectrum. Might mention one other tidbit. This is sort of the third leg towards understanding the foreign markets here, and that's really the currency policy. And this is really, I might mention, this is sort of like an extra point of subtlety here. It can make the headlines in a fairly big way, but to me this is probably number 3 on the list of 3, so it's probably the least important, but still relevant. And it depends on whether the currency is set up as a floating currency like Canada, a pegged currency perhaps like Nigeria, or maybe a banded currency like China. In particular, the pegged currencies are the headline makers, because during a strengthening dollar environment, what you'll see is sharp devaluations. And I mentioned Nigeria is probably top of the list, where they devalued here. It was probably not quite a year ago, and is a sharp devaluation because they can't support the value of the naira anymore. The floating currencies like Canada, we see Canada gradually drift down as less capital investment into Canada, and strengthening dollar in the U.S. Becomes a kind of a self-reinforcing cycle, and so the Canadian dollar sort of drifts down. And what's interesting about the floating currencies in Canada is, from the perspective of a Canadian citizen, that has a tendency to cushion the blow of a softening in oil price. So even though the oil price is priced in U.S. dollars to the average Canadian in Canadian dollars that softened at the same time, the price has only declined probably maybe half to two-thirds as much as the full decline that we see here in the U.S. So a little bit of a softening blow, and the pegged currencies would like to track that, but usually pegged currencies will make their adjustments in a step function, perhaps every year or so, when they know that they need to make that adjustment. If you're an investor in a pegged currency that goes through a devaluation, there's usually a sharp downward move, and so it's one of those little investment advisories that you have to kind of make sure that you're not tied too strongly to pegged currencies that are at risk of devaluation. And even floating currencies, you have to sort of keep that in mind about what direction things are headed. So this slide sort of summarizes what the three main topics we were talking about with emerging markets, but clearly there's a producer bias in most emerging markets, not all, but most. I might mention there's a producer bias in a couple of countries like Australia, Canada as well, but they are exposed to the commodity route. Secondly, that a lot of emerging or basically non-U.S. markets can be exposed at both ends with trade deficits and trade surpluses. And then lastly, especially with pegged currencies and to a lesser extent banded currencies, there's risk of additional devaluations, which is something you really have to pay attention to. So you add those three together, and that's probably a good explanation for why the emerging markets are under such pressure here, with the dollar rallying so strong in the last year and a half. We talked a little bit about the first two items about raw material prices declining and emerging markets underperforming. Those are kind of negative topics. Let's talk about something positive now, about the consumer and why the consumer is in just such fantastic shape. And the most obvious reason why the consumer is in good shape is that with all the raw material prices dropping, the consumer feels a little bit better. The energy prices drop, the food prices drop, material prices drop, and basically the consumer has more money in his wallet. Probably no surprise then that in the last year and a half with the dollar strengthening, we've actually seen a nice improvement in consumer confidence. Now granted, this is just US, but still the consumer, we are seeing a benefit. Lower fuel prices, lower food prices, lower materials prices, more money in the wallet. We've alluded to this earlier, but from the perspective of the investor, a lot of the consumer stocks have a tendency to outperform in a strong dollar environment. First of all, the consumer is healthier. Secondly, a manufacturer of consumer goods, well, the cost of manufacturing the goods went down because the price of the materials went down, and so therefore the margins and earnings have a tendency to expand, and that's certainly good for the stock price. So consumer stocks have a tendency to outperform in a strong dollar environment. Here's a nice little bar chart here to kind of put a little bit more emphasis on how consumer stocks do. You can see 2015, this is as of a couple of weeks ago here, so very early December, but clearly the two consumer sectors in here are outperforming the vast majority of the S&P, and in particular outdoing the weak dollar energy segment as well as the weak dollar materials segment. There are a couple points of subtlety when it comes to understanding why consumer stocks benefit and in a strong dollar environment, and I might mention that there is a difference between a strong dollar and a strengthening dollar, that a strong dollar at a broad level does benefit all consumer names, but a strengthening dollar really only benefits consumer names with U.S. revenue, and you can kind of see that situation that a strong dollar drops the price of commodities worldwide, but a strengthening dollar means you're getting devaluations in other countries, and so if you own a consumer name in say Korea or Japan, when they're devaluing, you're going to see the devaluation of your consumer company asset there too. Once the devaluation is done and the dollar's strong, that consumer name in the foreign country will perform just fine, but during the strengthening process it's a little bit rough. So dollar strong, good for everybody. Strengthening dollar, really only good for U.S. revenue companies. You can see that just couple of names here locally, U.S.-based names, but Coca-Cola has 80% of its revenue was outside the U.S. The stock is up, but not a whole lot, maybe up 5% year to date. On the other hand, Monster Beverage, 100% revenues in the U.S. The stock is on fire. It's up 30%. Clear beneficiary of both a strong dollar and a strengthening dollar. Coke only gets one of those benefits. There's one other little important observation about consumer stocks, and that's that relevance and fashion actually do make a difference. Just because you're a strong dollar consumer stock and you put out the Edsel automobile, well, your stock may not do so well. So you do have to have some sort of level of fashion as well as relevance. Probably the best examples here are what's been happening with the bricks and mortar retail, which is seeing a ton of pressure from online competition. So you can see here with Amazon up 105% year to date, but Macy's on the other hand down 44% year to date. A bricks and mortar retailer like Macy's having a very tough time competing with Amazon. So anyway, not all stocks can benefit in the consumer space from a strong dollar. I might mention this is in contrast to in the weak dollar days when energy and raw materials do well. There's a tendency for all metal stocks do well, all oil stocks do well, all grain or fertilizer stocks do well. They all have a tendency to do well at the same time. Consumer stocks don't get that. There's a much wider dispersion of returns within consumer names. You have to be fashionable and relevant. You cannot be unfashionable or irrelevant. That's not a factor for oil stocks in a weak dollar, but it's a big factor for strong dollar stocks for consumer names. Lastly, I thought I'd talk about one other positive, the final positive here for strong dollar effects, and that's the tech and biotech sectors have a tendency to take off quite nicely during strong dollar days. And we can think back to the late 1990s and the dot-com bubble, which also happened, I might add, at the same time as that human genome biotech bubble. Not a coincidence that those happened in the late 90s when the dollar was last roaring strong. No guarantee that we're going to get a similar type of bubble as we move into this phase of strong dollar days again, but they do, there's no question they do have a tailwind. We'll talk a little bit about why here in a second. So let's go back to this chart we were talking about earlier with emerging markets and then think about developed markets. In the strong dollar days of last year and a half, we can clearly see the large outflows from the emerging markets over here. Whereas the inflows into the developed markets, well, they're doing a ton better than the emerging markets. Still not a great tailwind, but at least a tailwind. And to me, that's kind of the root, who's got the tailwind, who's got the headwind. In a strong dollar market, as we just saw, the developed market does have the tailwind. It's not a strong tailwind, but it is a tailwind. And in that type of market, the S&P tech sector is what's referred to as the highest beta sector within of the 10 S&P sectors. Beta basically meaning most volatile, meaning it goes up a lot as well as down a lot. The beta of the S&P tech sector right now is 1.4, which means if you get the S&P to rally 10% in a strong dollar environment, the average tech stock will be up 14%. And so if we're getting developed market inflows, the sectors that benefit the most would be the ones that have the highest beta, which would be tech. Biotech is kind of right behind it. Biotech usually is lumped in as a subsector with healthcare overall. Biotech is sort of the highest beta subsector within healthcare, which is actually a relatively low beta, but biotech itself has a similar beta, about a 1.3 to what the tech sector is. It varies a little bit if you're talking about sort of a blue chip biotech versus a smaller biotech, but generally speaking, they are higher beta names, and they will clearly see an outsized benefit from market inflows during strong dollar periods. Again, like with consumer stocks, not all tech stocks are identical. I gave a few examples here. Apple versus Nokia, Facebook versus MySpace, Google versus Yahoo. Clearly you have to be in fashion, you have to be relevant. Again, unlike the weak dollar period when oil stocks were strong, people did not really distinguish, Exxon from Chevron, from Occidental, from British Petroleum. They all went up at the same time. We don't really have Apple going at the same time as Nokia or Facebook and MySpace. No, you're either working and you're relevant, or you're out of step. So you do have to pay attention. There's a wide dispersion of returns. There's wind at the back, but there's going to be winners and there's going to be losers. As with the earlier example of Monster Beverage versus Coca-Cola, it does help if you've got a technology company that is basically 100% U.S. domestic as opposed to a global technology company. I did give a couple of anecdotal examples here, like Netflix, for example, which is very much a U.S.-based kind of quasi-consumer tech name. Not really impacted too much by foreign currencies. Microsoft is probably a tweener. It definitely has non-U.S. revenues. It does seem manageable as a U.S. bias, but it's definitely not, mostly. It does have quite a bit of non-U.S. Micron, on the other hand, is 80% non-U.S. and is facing a very stiff currency headwind. So technically, Micron is in the tech sector. But it has a headwind that is sort of unlike what you would see at, say, at Netflix. Might also mention too that Micron is very early in the value chain. I wouldn't put it at the raw materials end, down with copper and oil and gold, but it's maybe a couple of steps above that, with the silicon wafers. And so it also benefits from being earlier, or excuse me, gets hurt from being earlier in the value chain compared to a consumer good or service like a Netflix. So again, not all tech companies are the same. You have to pay attention, and the U.S. bias makes a big difference. The biotech sector should also see, the higher beta inflows. There are quite a few similarities between tech and biotech, in particular the relevance that really makes a difference, and fashionability. Relevance for biotech is not necessarily having a better smartphone. Instead, for biotech, it's having a better, say, treatment for cancer or arthritis or some other new biotechnology advancement. They're not exactly the same, though, and in particular here coming up into 2016, biotech is probably going to see a bit of a headwind that technology will not face, and in particular, drug pricing was likely to be an election year campaign topic, and so there may be a little bit of a risk discount in biotech that might float around for the next 12 months or so while that becomes an election year topic. So might also mention too, on one other difference that's positive for biotech is that the vast majority of large biotech and pharmaceutical companies have very little in the way of non-U.S. revenue. For a variety of reasons, that does make them very U.S. centric, and that ought to be a positive looking into 2016. So this kind of gives you the whole conclusion about, or the list of conclusions about the strong dollar environment, and what does well, what does poorly in this kind of environment. To some extent, we can sort of see this just by looking at sector performance over the last 18 months, and we know that raw materials have done poorly. We know that emerging markets have done poorly. We know the consumer stocks in tech and biotech have done well. But hopefully this gives a little bit more of a elegant understanding for why the sectors have done what they've done. You can grab the grouping of sectors and the rationale for why the sectors have done what they've done, and then construct a list of characteristics of the type of investment that will work in a strong dollar world. We know already that U.S.-based revenue is an important factor. Being at the finished goods end of the value chain, very important. Having that technology or relevance is very important. Also, it always helps to have a little bit of a higher beta name so you can benefit from inflows. With thinking about that, there's really the four sectors that I would regard as the strong dollar sectors, and we talked a little bit about this earlier. The consumer names, cyclicals and staples, as well as healthcare and information technology. Those are the strong dollar sectors. Just because you're in their sector doesn't necessarily mean you are a strong dollar beneficiary. Again, Coca-Cola is in the consumer staple sector, but 80% of the revenue comes from non-U.S. And so you might start by looking at those four sectors and then use the four bullet points here as a checklist to see how well they stack up. You could use a sort of a similar thinking about what type of investments work in a weak dollar environment, or maybe I should say what stocks are likely to go down in a strong dollar environment. And of course, we could just grab the S&P sectors over the last 18 months, and we'll look. It should be very obvious that the energy sector and the raw material sectors are both pretty rough, being at the raw material end of the value chain and also having a significant amount of non-U.S. revenue. Of course, emerging markets, we already talked about that, also have done very poorly in the last 18 months, and hopefully we have a little bit more of an elegant understanding for why that is. So we now have a little bit more detailed understanding for the four basic factors, or the four outcomes of a strengthening dollar. The big question is, well, what actually moves the dollar higher? And I have a picture down here of a grouping of Federal Reserve governors or central bankers that I wouldn't necessarily say that central bankers are causing the moves, but I would say that the factors that mandate central banking moves are what's really motivating the move. And the short version of the story is basically that U.S. rates, if they're rising faster than non-U.S. rates, that strengthens the dollar. That's sort of an interest rate parity argument. But I might put geopolitics fairly high on that list, because you can get small moves, purchasing power parity, or medium, perhaps even big moves. But the really huge moves are usually geopolitics. And thinking about back to, say, 2003, the dollar was running 20-30% overvalued for probably the previous 6 or 8 years. And why is it not coming down? Why is it not coming down? Well, when America went to war in Iraq in 2003, the dollar suddenly picked up a small risk premium, and then suddenly everybody realized the dollar was overvalued. And within about 24 months, the dollar had corrected from 20 to 30% overvalued to about 10 to 15% undervalued. Very sharp period of time. It took a geopolitical catalyst to actually force that move. And of course, we've seen a similar move here in the last 18 months, when we saw a little bit of a strengthening of the dollar with Abe in Japan doing some proactive weakening of the yen. But what really moved it was when Russia went into Crimea. The European Central Bank decided to knock the last legs out from what's called the carry trade and drop their rates negative, with the policy statement that they need to drop the value of the euro to make the European exporters more competitive. In reality, that's not quite the whole story. Those were all very true words, but it wasn't really the whole truth. The reality is that they knew that if they could strengthen the dollar, they could weaken oil, which would take away the Russian threat sitting at their back door. They knew that after Russia goes into Crimea, that there would be German and European and NATO sanctions against Russia, and Russia could respond to those sanctions in the winter by shutting the heat off of Europe, since they supply most of the energy. And the only way Europe could really get in front of that was to drop the price of oil. And so the geopolitics basically were a very big factor towards causing, not the only factor, but a very big factor to causing the sharp rise in the dollar here. And so those are the sparks. You really had to kind of keep your eyes open for that. And to me, I have a tendency to look at it, keep an eye on which currencies are bent out of shape on a purchasing power parity basis, and then don't necessarily bet against the valuation trend, but rather just wait for the geopolitics to make it more obvious. Might mention there's the self-reinforcing factors that we talked about, that once the dollar starts to strengthen, you run into competitive devaluations around the world. You also run into capital flight issues in many emerging markets. And so it's one of the reasons why once the pendulum starts to move, it moves for a really long time. And so that is, to some extent, our outlook for 2016. We'll talk about that in a little bit. But there is a move that goes for a long time. Anyway, those are the factors that I think move the dollar higher. This slide, I just have some rough thoughts about 2016 and what that might bring. First of all, we do know that the rise in the dollar, while it was overdue, the dollar has been undervalued for most of the 2003 to 2013 period, with the exception of the 08-09 recession. And so we've been sort of awaiting a geopolitical event to catalyze a move forward. We did get that. But does that mean it's over? I mean, we've had a big move. The dollar's gone from undervalued to even perhaps a tiny bit overvalued. But my gut feel is no. I don't think we're going to see the dollar reverse. The pendulum move takes a really long time, and even though it's moved especially fast this time, I think it's more likely that what we'll see in 2016 is sort of a gradual strengthening, quasi-stabilization of the dollar. Right now we're running about 109 on the euro. If I were to take a guess, a year from now, we'll be down close to parity, but probably still above it, probably in the dollar to $1.05 against the euro. And probably similar moves on other countries. There may be a few devaluations between here and there on some of the smaller countries, but I don't see any of the major countries. I think we get a little bit more weakening in China. They're joining the SDR basket here just in the last month or two. Does give them a bit of a kind of an excuse to let their currency slide a little bit, and their currency does need to be devalued. So anyway, that's the outlook on the dollar from my perspective here. If we have a market in 2016 where the dollar continues to rally, but perhaps not quite as strong, then what we ought to see is similar types of stocks move in 2016 as we've seen in 2015 and in 2014. And so as long as it's been with consumer tech and biotech names kind of rallying, and oil and gas and energy and raw materials faltering, the likelihood is we're going to see a similar but slightly diminished picture next year. You might remember in the 1990s when Greenspan made the irrational exuberance call in 1996, and then the dot-com bubble went for another 3.5, 4 years. Well, this last year there's been a lot of attention not on dot-coms, but basically the 2015 equivalent to dot-coms. They're calling them the FANG stocks. Facebook, Amazon, Netflix, Google. Those are dead on in the kind of the classic strong dollar type of 1990s type of stock. A little bit more mature. There's a little bit more of an institutional memory of what happened to the dot-com bubble, so people aren't. They're a little bit cynical about unicorns and whatnot and giving infinite valuations to new IPOs, but they're absolutely throwing money at these types of internet properties again. And so gut feel is it's going to be yet another year of those FANG stocks continuing to do well, as much as value investors like me sort of fear valuations. I also have to be realistic about what's going to work, and I have a hunch. It may not necessarily be the FANG stocks, because people like me are going to be looking very hard for alternatives. Maybe it might be an Apple, but a consumer tech type of name that is likely to do quite well in 2016. Biotech, in theory, ought to have a huge tailwind, but it is an election year this year, and so we might get a little faltering there. I'd still have some exposure in the space, but I probably wouldn't be quite as overweight as I was in the last year or two. Oil stocks, I think those are probably going to be traders in 2016. Likelihood is there's going to be more down than up, but not a whole lot more down than up. My gut feel is we'll probably get a little bit of a seasonal recovery, probably in the second quarter again. But it won't be a long-lasting seasonal recovery. So again, probably a trade in those stocks, and I'd probably lump that in with a handful of the other commodities. One of the other areas we have, the last year we've been talking a lot about the Nifty 9, sort of a FANG stocks plus maybe 5 others that have done very well, and the vast majority of the market hasn't done well at all. I think the broader market will probably do a little bit better in 2016 than 2015, but the advancers will still be fairly narrow, and so it will still be a narrow market, but a slightly healthier market. So again, value investors like Glacier Peak, we do have to be very careful in this kind of market. We don't want to jump into egregiously overvalued stocks because we are value investors, but we also need to participate in the names that are working. And so we'll be trying to tread that fine line. I threw this last slide in here as an appendix, sort of some common observations. You think in particular about the the 4 main factors that, or 4 main results of a strong dollar, and there's been a handful of sort of popular theories over the years about why oil is strong or China is strong or weak, and I think we can take a step back now with a little bit deeper understanding and sort of call a couple of these theories on the carpet for what they really are. Anyway, this is just a little bit of a sort of a, I'm not sure I would call it "see I told you so," but it's maybe just making sure that we're thinking about things properly. First of all, I might talk about Hubbard's Peak, and I know this was hugely in fashion in 2004, 5, and 6. It's probably not quite as in fashion now. I think people are seeing through the connection between the oil and the dollar and understanding that the world's actually not really running out of oil. Also, with the invention of fracturing in the oil and gas space, there's a little bit more plentiful supply. But I do just have to kind of call Hubbard's peak on the table here, because it just seems ironic that in the 1970s there was a lot of books published about the U.S. running out of oil, and then when the dollar went weak again in 2003, there was again a whole slew of books published about the world running out of oil. And to me, I think that's probably the correlation that we need to think about longer term, that maybe some time in the future, I don't know if it's 5 years from now or 50 years from now, but we're going to have a weak dollar period again, and there'll be a bunch of books sold again about running out of oil. And so let's hope we can kind of get over that and think about what's really driving the price of oil. It's not running out of oil, it's a currency. Along similar lines, let's talk a little bit about, when the price of oil went crazy, a lot of people pointed the finger at China and said, well, China's absorbing all the oil demand. And there's no question that China did absorb a lot of oil demand. But I'm hoping, again, that we can be a little bit more sophisticated in our understanding now, knowing about how currencies work, that when China has a pegged currency to the U.S. dollar with an export economy, and then the dollar drops by 30%, that pours an awful lot of gasoline all over the Chinese economy. At the exact same time, the price of oil drops because of the bullwhip effect of pricing. But saying that China caused the increased demand in oil and therefore is causing the price increase of oil, no, you're confusing cause and effect there. And so the China miracle was really all about a currency-induced miracle. The oil rally was a currency-induced phenomenon. The fact that they happened to coincide at the same time, I wouldn't call it a complete coincidence, because they were actually both caused by the same factor, but let's hope we can be a little bit deeper thinking next time and understand what's a currency move and what's a supply-demand move. There's a third little point here I just thought I'd make here, and trying to raise the level of conversation, but and this is mainly aimed at folks that work in emerging markets, perhaps a little bit more of the frontier markets in the development area. And people look at perhaps the country of Nigeria, and they say, what a phenomenal country it is. We're doing some development work to help feed the people, and there's biggest economy in Africa now, and growing nicely. And look at this wonderful resource base. And let's take a step back there and think about that, because the resource base was a wonderful thing when the dollar went weak, but as the dollar went strong, having that resource base didn't allow the country to diversify its resources. And I realize that this particular phenomenon here, you can do a Wikipedia on the word resource curse, but again, I'm hoping that that my constituents, the people that I speak with, will be able to rise to a higher level here, and when they read the you see some commentary from development economists about the wonderful oil resources of Nigeria, they can take a step back and realize that there are some benefits, but that the negatives frequently outweigh the positives. Venezuela comes to mind as probably a more egregious example of resource curse. Along similar lines, folks that are doing third world development, the idea that Nigeria is just like the U.S. was in the 1950s, 40s, 30s, and that they'll develop along a similar growth path, and that they're just sort of a younger version of the U.S. and the U.S. used to be this way. Yeah, I think we need to kind of rise to a little higher level on that as well, because when you think about why the industries are working, it's possible that there may be some shortcomings in technology and infrastructure that does involve a growth aspect, but let's think real strongly about the currency aspect too, and what is actually possible in a currency environment. So lastly, probably one of the more important items here, I'm hoping people can rise above here, is that when people think, and not just about oil, but it could be copper, copper or wheat or any of the raw material commodities, that there's a tendency for people to view the dollar price of oil looking at, say, supply, which oil supply, people have a tendency to focus on Saudi Arabia and maybe a few of the OPEC countries. demand. They have a tendency to look at the U.S. GDP, maybe world GDP. But if you look for a dollar price where the supply-demand curves cross, but you don't think about the fact that the supply-demand curves are crossing and giving you a dollar price, but you ignore the value of the dollar, you're really focusing on the wrong item. You need to start, number one, with the value of the dollar. Once you've figured out where the dollar is going, then you can work on supply and demand next. Supply and demand are a distant number two in terms of determining commodity prices, a very distant number two. So anyway, that concludes the talk, and thank you all for listening.